Hi, and welcome to this problem. So this is exercise 11 in chapter 4. So this is a statement of shareholders' equity, and we're given the following information that came from its balance sheet. So we can see the contributed capital, and so all the items under contributed capital represent value that came from investors. So preferred stock, common stock, this is listed at its par value, and then additional paid-in capital is anything that was given in addition to or that exceeded the par value of the stock. So whenever we issue stock, we don't expect to get par value, we expect to get market value, which is usually higher than par value. So we just list the stock at its par value, and then anything that we got in excess of that goes into paid-in capital. And then this gets us to our total contributed capital, also known as paid-in capital. Retained earnings is all of the earnings that we have in our company minus any dividends. And then the total shareholders' equity is the total contributed capital plus the retained earnings. So then it tells us that during the year we had these transactions. And the book gives you one way of doing it, but I want to show you another way of doing it. And if you understand both ways of doing it, then that's really the best thing. So we're going to first look at what these transactions do to our T accounts so that we can see what the new balances are. Then I'll show you the table that Cengage asks you to use, and we'll make sure that you know how to fill that in as well. So the first thing that we're going to do is put in our beginning balances. So our beginning balances come from our prior balance sheet. So preferred stock is $100 par value. We care about this $92.8, so this is going to be our preferred stock. So I'm going to open up a T account, and I'm going to name it preferred stock. So you do the same thing. And preferred stock has a normal credit balance because all capital has a normal credit balance. And so I'm going to put its balance on the credit side, which is the increase side. All right, and I just referenced that cell so that I didn't have to type in the number. So I just typed in E equals E5. And then I'll do the same thing for common stock. Again, it's still a capital account, so it has a normal credit balance. So it is $37,400. Additional paid-in capital on preferred stock. I'm going to do APIC preferred stock. And it's still a capital account, so it still has a normal credit balance. Then I'll come over here and do additional paid-in capital for common stock. And that one is $58,700. And total contributed capital is not an account, that is just a subtotal. So I'll go to my next account, which is retained earnings, which is $185,700. It also is a capital account, so it also has a normal credit balance. So its balance goes on the credit side. All right, now I'm ready to put in my transaction. So Powder issued 1,800 shares of common stock at $13 per share. So if I want to know the entire amount that I received for issuing this, I would say 1,800 times $13 per share. That's going to tell me the amount that I got. 1,800 shares times $13 a share. I received $23,400. Now remember, I only want to put it at common stock at par value. So what is the par value of my common stock? I look up there and it says common stock has a par value of $5. So I'm going to put it at 1,800 shares times the par value, which is $5. This is the amount that I'm going to put it to common stock. This amount right here is the amount that will go to cash, and the excess of the cash that I got and the amount at par goes to additional paid-in capital in excess of par. So now I'm ready to journalize it. So I'm just going to make a note over here so that you know what I'm doing. I'm going to debit cash for $23,400. I'm going to credit common stock for $9,000. And I'm going to credit paid-in capital on common stock for $14,400. I'm going to make this to where you can read all of that by just merge and center, wrap text, make that a little bit taller so that you can read everything that I wrote in there. Okay, so here I go. I'll make it cash just so I can see what I'm doing to cash. I don't have a beginning number in cash though. So 23,400 made cash go up. Common stock went up by the par value of it, which was 9,000, and paid in capital in excess of par for common stock went up by 14,400. All right, let's keep going. Powder issued 340 shares of preferred stock at $130 per share. So let's do the same thing. So for my preferred stock, to figure out how much money I got, that's going to be 340 shares times 130. That's how much cash I got. I'm going to put it at par value. I'm going to change this to say at par value because now it's common and preferred stock. So that would be your number of shares, 340, times par value of preferred stock. And if I come up here, I can see that my par value of my preferred stock is $100. So I'll multiply this by $100, and that's it. So the excess is the amount of par over the amount of cash I got, or cash over par, and so that is 10,200. So my journal entry is going to look like, I'm going to copy this, just the, if it'll let me, let me see. I'm just going to copy the formatting so that I don't have to wrap and do all that again. And I'm going to debit cash for 44,200. I'm going to credit preferred stock for 34,000. And I'm going to credit paid in capital in excess of par for 10,200. So here I go. By the way, this would be neater if I left aligned it, so I'm going to left align it so I can read it better. All right. So cash went up by the whole amount that I got, which was 44,200. 44,200. Preferred stock went up by 34,000. Paid in capital in excess of par for preferred stock. Wait, this is additional paid in capital. Preferred stock, sorry about that. Preferred stock went up by 34,000. Paid in capital, I didn't see that APIC right there. Paid in capital in excess of par for preferred stock went up by 10,200. All right, so let's make sure I did that right. Cash went up by that. Preferred stock went up by 34,000. Additional paid in capital preferred stock went up by that. All right, then Powder paid a $7 per share dividend on the preferred stock and a $1 per share dividend on the common stock at the end of year 7. So we are in year 7. Yeah, year 7. And at the end of the year, we paid those two. So how much do we pay to preferred? Well, let's see how many shares of outstanding we have of preferred. It doesn't tell us here, but we always have a way of getting it. I don't know how many shares outstanding I had here, but I can figure that out because I know that it's always listed at par value, and my value is right now 92,800. So ask yourself, how can I figure out how many number of shares? Well, I know that number of shares times par value gives me 92,800. So if I want to solve for number of shares, I can just say 92,800 divided by $100. And that's going to tell me how many shares. 92,800 divided by 100. So I have 928 shares. While we have that in our mind, let's just do that again. For this one, I know that the number of shares, which is what I don't know, number of shares times par value, which is $5, equals 37,400. So if I want to solve, I can say 37,400 divided by 5, 37,400 divided by 5, and that's how many shares I have. However, I issued more shares. So in number 1, how many more shares did I issue of common stock? Well, I issued 1,800 more. So at the end of this, I have that number plus that number. This is my new number of shares. And here, for preferred stock, I had issued an additional, in number 2, 340 shares. So the new amount of outstanding shares are this. So when I go to pay my dividends, that's what I'll be paying them on. So let's go figure out what that is. So for preferred stockholders, I have $12.68, and it tells me that I paid $7. So I'm going to pay my preferred stockholders this amount of dividends, $88.76. And for common stockholders, I now have 9,280 shares, and I'm going to pay them $1 per share. So the total amount of dividends that I'm going to be paying, I'm going to add up my preferred and my common, is $18,156. Alright, so what does that journal entry look like? Well, that journal entry is going to be, we learned that there are 3 dates to paying dividends. There's the date of declaration where we set up the liability, then there's the date of record, and then there's the date of payment. So we're really just going to be concerned with the main journal entries here. So we're going to be concerned with reducing retained earnings by those, which is $18,156, because that's what dividends do. And we are going to be reducing cash by $18,156. All right, let me talk about how I got to that, though. So when you pay dividends, you declare dividends, then you do debit cash dividends, and then you credit dividends payable. That's what I mean by setting up the liability, because I credited a liability and I'm setting it up. Then the date of record, we don't make a journal entry. We just figure out who's going to receive it based on who is holding that stock as of this date, as of this date of record. No journal entry. When we go to pay it, we're going to get rid of dividends payable and pay out cash. So that means that all we've done really here, besides paying cash, is to debit cash dividends. Well, when cash dividends closes, which we always close dividends to retained earnings, we would credit cash dividends to get rid of it and debit retained earnings. So you can see that it does end up here as a debit, and that's why I put it straight to that. Plus, it just makes sense that when you distribute earnings, it reduces retained earnings. Our increase side is over here, so this decreased it. So our new balance and our retained earnings looks like that. All right, so let's get our new balance everywhere. So our preferred stock is now this. Our common stock is now that. Our additional paid in capital for preferred stock, we'll add those two together. Our additional paid in capital for common stock is here, and we don't really worry about cash because we didn't have beginning balances, so it's not a true number. Okay, so now what we want to do is we want to prepare the statement of owner's equity, including retained earnings for year 7 with these updated numbers. So what it does is it asks us to put it into this chart to help us to figure it out. So the balances for January 1 of year 7 are given to us. So preferred stock started off with 92.8. Common stock started off with 37,400. Additional paid in capital for preferred stock started off with 21.5. Additional paid in capital on common stock started off with 58.7. Retained earnings started off with 185,700. And when we total that across, we get 396,100. I'm going to add some commas in here so that everything is easier to read. And then you have to know what we did. You have to know those journal entries. All right, so when we issued our common stock, we put 9,000 at par value. And then we put the rest at paid in capital in excess of par. So I found 14,400 right there. And I'm just going to copy this formula down, grab that fill handle, hold it down, and copy. And then when we issued our preferred stock, we put preferred stock at par of 34,000. And then additional paid in capital for preferred stock was 10,200. I see that right there. And you can see that these totals equal the total of cash that we got for those issuances. Then I need to look up here for net income. They must have given it to me someplace. So I'm going to go on a hunt over here and try to find net income. It says on January 1, provide the following information from the stockholders' equity section. During the year, the following transactions events occurred, were properly recorded. Oh, here we go. Number 3. Powder earned net income of $38,950. So let me drop in my net income. Net income increases retained earnings, $38,950. And then I took out some money of retained earnings by paying those dividends. So for preferred stock, I paid $88.76 preferred stock minus $88.76, and common stock was $92.80. So now my new balances, I'm just going to be going from what I started with, adding up anything that I added. To get to my new balances. Additional paid in capital for common stock will be this. Retained earnings is what I started with, plus my net income, plus the negative for the dividends, which will net those out. And I'm going to make sure that I cross-foot, so I'm going to add up these and make sure that it equals that. Let me try it again. 484,494. I'm going to add down to make sure that equals, and it does, so it appears that everything is okay. So that is how I would create my updated stockholders' equity for the end of the year. So let me know if you have any questions on that. Thanks.